When looking at the top 5 ETF for long-term investment, most investors miss a critical fact. Only 2 sectors have actually outperformed the S&P 500 over the past decade. Yes, only 2 out of 11. The stock market has 11 different sectors: consumer discretionary, energy, healthcare, technology, and 7 others. And I wanted to cut through the noise and show the best ETF for long-term investing based on actual 5-year total performance. Before jumping into the list, here's a question that trips up even experienced investors. If 2 ETFs have similar strategies, and one returned 13% annually over 10 years with a 2% expense ratio, while the other returned 12% annually with a 0% expense ratio, which one gave better returns? The answer? The first one, the 13% ETF. Why? Because total return already accounts for expenses. The expense ratio is baked into that number, and dividends are assumed to be reinvested. This is critical to understand when evaluating the best ETF to invest in 2025 for long-term growth, because comparing raw expense ratios without looking at total return is like judging a car by the sticker price without checking if it actually runs. Now here's the thing. This video is titled Top 5 ETF for Long-Term Investment, but I'm actually giving 10. Not all 10 are in this video. I'll give you the next 5 in my upcoming video. So consider subscribing to the channel if you do not want to miss them. I'm Andrew. I'm building $1 million portfolio, and I'm breaking down every move, every strategy, and every lesson along the way so you can do the same. Let's get started with the best ETF for long-term investing across all 11 sectors, ranked by 5-year total performance. First up, we have energy. The energy sector has had a 10-year annualized return of 4.83%, well below the S&P 500. During its best year, energy spiked 65.7%, but its worst year? Down -34.9%. Volatile, cyclical, and heavily dependent on policy and commodity prices. The top-performing ETF in the sector is the Invesco Solar ETF, ticker TAN, which narrows its focus to a subsection of energy, solar. Top holdings include First Solar, Enphase Energy, and SolarEdge Technologies, not household names for most, but companies that have been riding the renewable energy wave for years. Here's where it gets interesting. As of October 2025, TAN is trading at $46.24, down -23.6% year-to-date. The sector is under pressure from tighter U.S. policy restrictions and macroeconomic uncertainty. But the 5-year annualized return? 22.1%, substantially higher than the energy sector's average of 3.77%. Analyst consensus rates TAN as a buy, with expectations of long-term growth once policy headwinds subside. The thesis here is simple. Solar adoption is accelerating globally, and despite short-term volatility, the trajectory over the next decade favors renewable infrastructure. The strategy is focused. The performance has been strong over 5 years. And right now, the fund is being sold off while the long-term tailwinds remain intact. That's a pattern worth watching. Now let's talk numbers. If someone invested $50,000 into TAN at the beginning of its 5-year run and held through the 22.1% annualized return, that position would be worth approximately $138,000 today. A $100,000 investment? Around $276,000. That's nearly tripling the initial investment despite the current year-to-date decline. The volatility is real. The short-term pain is visible. But the 5-year compounding? That's where the thesis plays out. Next up, utilities. The sector has had a 10-year annualized return of 8.86%, still below the S&P 500, but notably less volatile. Its best year underperformed the index, but its worst year held up better. That's the trade-off. Stability over explosiveness. The top ETF here isn't a traditional utility fund. It's the Global X U.S. Infrastructure Development ETF, ticker PAVE, which focuses on domestic infrastructure companies with over 50% of their sales in the U.S. Top holdings include construction firms, supply chain operators, and industrial manufacturers like those tied to Home Depot, Sherwin-Williams, and related infrastructure build-outs. As of October 2025, PAVE is trading at $46.42, up a strong 18.8% year-to-date, with a 5-year annualized return of 13.8%. The fund has benefited from sustained U.S. infrastructure spending, both government-backed projects and private sector construction tied to data centers, logistics, and manufacturing reshoring. Analyst consensus is neutral to positive, with Morningstar rating it neutral while Seeking Alpha and others see continued opportunity, especially with recent government infrastructure investments providing long-term support. This wasn't even on the radar until researching for this video, but when a fund consistently beats its sector average by 5% annually and has tailwinds from multi-year infrastructure spending, it moves to the shortlist. Infrastructure doesn't make headlines, but it generates returns. Let's run the numbers. A $50,000 investment in PAVE over the past 5 years, compounding at 13.8% annually, would be worth approximately $95,000 today. A $100,000 investment? Around $190,000. That's with dividends reinvested and steady exposure to multi-year infrastructure tailwinds. Not the flashiest sector. Not the most talked about fund. But consistent 13.8% annualized while the broader utilities sector averaged far less? That's the kind of quiet outperformance that compounds into real wealth over time. The third one is communication services. Communication services has had a 10-year return of 6.9%, with performance trends similar to the S&P 500 during both bull and bear years. The best-performing ETF in the sector is the First Trust Inc.'s NextG ETF, ticker NXTG, which tracks next-generation digital cellular technologies. Essentially, the infrastructure and companies behind 5G and telecom expansion. Here's where it gets slightly messy. NXTG's top holdings include Nvidia, Intel, and Samsung, which technically makes this a bit of a hybrid between communication and technology. It's leaning on tech for growth, which some might call a cheat for the sector classification. But the fund also includes core telecom and communication-specific companies, and the sector weights are balanced enough to still qualify. As of October 2025, NXTG is trading at $104.94, US version, up 22.16% year-to-date and 18.87% over the past year. The 5-year annualized return is 9.01%, nearly double the sector average. Analyst consensus? Hold from Zacks. It's not a screaming buy, but it's a fair pick for exposure to both telecom infrastructure and the tech companies driving 5G rollout globally. The fund is benefiting from the 5G infrastructure build-out, but it's getting a lot of help from its technology-heavy holdings. Still, for diversification into communication services with some growth kicker from tech overlap, it offers a middle ground. Here are the returns. A $50,000 investment in NXTG over the past 5 years, compounding at 9.01% annually, would be worth approximately $77,000 today. A $100,000 investment? Around $154,000. Not explosive, but nearly double the communication services sector average. So far we've covered energy, utilities, and communication services. Sectors that are stable, infrastructure-driven, and showing solid 5-year returns despite short-term volatility. But here's where it starts getting interesting. The next two sectors include one of the two that have actually beaten the S&P 500 over the past decade. And the holdings? They're names most people see on a daily basis. Companies that weather downturns better than almost anything else. Let's keep going. Real estate. Real estate as a sector has had a 10-year annualized return of 7.66%. Its best year nearly surpassed the S&P 500 by 14%, but its worst year was also significantly worse, over 5% below the index. Real estate is cyclical, interest rate sensitive, and right now, it's navigating one of the most challenging environments in years. The top ETF for the sector is the Pacer Industrial Real Estate ETF, ticker INDS. And the strategy here is straightforward. 100% of revenue comes from industrial real estate activities. Think warehouses, storage facilities, and logistics hubs. Top holdings include companies tied to e-commerce fulfillment, cold storage, and data center real estate. These are the safer areas of real estate. Office space, retail. Those are under serious pressure. But industrial real estate, especially logistics and storage tied to e-commerce growth, has held up remarkably well. As of October 2025, INDS is trading between $36.01 and $37.82, up only 3.7% year-to-date and 10.54% over 5 years. The fund also carries a 2.86% dividend yield, which is baked into that total return figure. Analyst consensus is hold from Zacks, with improving prospects as industrial REITs are viewed as having higher total return potential despite sensitivity to macroeconomic conditions like interest rates. Here's the reality. Commercial real estate broadly has concerns, especially retail and office space. But industrial real estate? That's a different story. The e-commerce infrastructure isn't going away. The logistics build-out isn't reversing. And with interest rates potentially stabilizing or coming down over the next 12 to 24 months, industrial REITs could see a second wind. Now let's talk numbers. If someone invested $50,000 into INDS at the beginning of its 5-year run and held through the 10.54% annualized return, that position would be worth approximately $82,000 today. A $100,000 investment? Around $164,000. That's with dividends reinvested and compounding over time. Not explosive, but consistent. And in real estate, consistency during uncertainty is worth paying attention to. Last one for this video. Consumer staples. Here's where things get interesting. Consumer staples has had a 10-year annualized return of 9.13%, and it's one of the two sectors that have outperformed the S&P 500 over the past decade. Let that sink in. Out of 11 sectors, only 2 have beaten the index over 10 years. Consumer staples is one of them. Why? Because people always need food, household goods, and basic consumer products, regardless of economic conditions. The sector's best year was lower than the S&P 500, but its worst year? Over 22% better than the index. That's the defensive profile investors pay for. Downside protection. The top ETF for consumer staples is the iShares U.S. Consumer Staples ETF, ticker IYK, which focuses on domestic manufacturers of consumer goods while excluding consumer services. Top holdings include Procter & Gamble, Pepsi, Coca-Cola, names most people see daily in stores, kitchens, and households across the country. As of October 10, 2025, IYK is trading at $68.41, down minus 3.51% year-to-date, with a 5-year annualized return of 12.6%. Yes, the fund is down year-to-date. And here's why. Inflation numbers have been slowly coming down, which hurts the top-line sales of these brands in the short term. When prices stabilize, consumers pull back slightly on premium-branded staples, which compresses revenue growth temporarily. But here's the contrarian take. Once inflation stabilizes fully, this ETF is positioned to bounce back quickly. The brands aren't going anywhere. The demand isn't disappearing. And when economic uncertainty creeps back in, whether from geopolitical tension, recession fears, or market corrections, consumer staples historically outperform. Analyst consensus is moderate based on aggregate ratings covering the major holdings, with expectations of improvement as inflation pressures ease. Let's run the numbers. A $50,000 investment in IYK over the past 5 years, compounding at 12.6% annually, would be worth approximately $90,500 today. A $100,000 investment? Around $181,000. That's with consistent dividend reinvestment and steady compounding through multiple market cycles. Consumer staples won't double your money overnight. But over the long term, it's one of the only sectors that has consistently outperformed the S&P 500 while reducing volatility and protecting capital during downturns. That's not speculation. That's the data over a decade. So we've covered 5 of the 11 sectors: energy, utilities, communication services, real estate, and consumer staples. And here's what the data tells us. Only one of these 5, consumer staples, has outperformed the S&P 500 over the past decade. The others, solid performers with specific use cases, defensive profiles, and infrastructure tailwinds. But they haven't beaten the benchmark over 10 years. Now here's what most investors don't realize. The remaining 5 sectors? That's where the real long-term wealth was built. We're talking about the second sector that beat the S&P 500 over 10 years, and it didn't just edge past the index, it outperformed with conviction through multiple market cycles. We're talking about sectors with double-digit annualized returns that aren't riding 1 or 2 lucky years, but have consistently compounded wealth for patient investors. And here's the thing that surprised even me during this research. One of those remaining sectors has delivered 20% plus annualized returns over the past decade. Not through speculation, not through lucky timing, through consistent, compounding outperformance. The best ETF for long-term investing in that sector turned $50,000 into over $300,000 in 10 years. Let that number sit for a second. $50,000 into $300,000. So if that piques your interest, stay tuned for the next video, and I'll meet you there. Here are some keywords that can help you find this video. 1. Top 5 ETF for long-term investment. 2. Top 5 ETF for long-term investment. 3. Top 5 ETF for long-term investment. 4. Top 10 ETF for long-term investment. 5. Top 10 ETF for long-term investment. 6. Top 10 ETF for long-term investment. 7. Best ETF for long-term investing. 8. Best ETF for long-term investing. 9. Best ETF for long-term investing. 10. Best ETF for long-term investing. Other keywords: TAN, PAVE, NXTG, INDS, IYK.